How's it going, everyone? This video is going to be about fair value gaps. What is a fair value gap? An imbalance or inefficiency. There's multiple terms for a fair value gap, such as imbalance, inefficiency, volume imbalance, but the most common term is known as a fair value gap. I will also touch on the difference between a fair value gap, a volume imbalance, and an inversion gap. Firstly, let's start off with the basics. What is a fair value gap? A fair value gap is a 3-candlestick pattern, where the first candle's low does not overlap the third candle's high, or where the first candle's high does not overlap the third candle's low. Let's take a further in-depth look into this. If you take the low in an example of a 3 series candles in a downtrend, if you take the low of the first candle and you drag that across, and you take the high of the third candle and you drag that across, because the third candle's high does not overlap with the third candle's low. This gap between the first and the third candle is what you call a fair value gap, which often acts as a magnet for price to fulfill before continuing in its direction. Let's use the example of a 3 bullish series candles. If you drag across the low of the third candle and you drag across the high of the first candle, because the high of the first candle does not overlap with the low of the third candle, this gap between the first and the third candle is called your fair value gap. Now that you understand what a fair value gap is, what does a fair value gap not look like? So in this scenario, if we do have a 3 series of bearish candles, but in the scenario, let's say the wicks of the third, I'm just going to remove this for now, and the first candle are overlapping. If I take a horizontal line and drag the high of the first candle across, and if I take another line and drag the line across the low of the third candle, you can see that these 2 wicks are overlapping. Therefore, in this scenario, there would be no valid fair value gap. Similar to a 3 bullish series of candles, just drag the wicks across, and now if I take the high of the first candle and drag that across, and the low of the third candle and drag that across, you can see that the high of the first candle and the low of the third candle is now overlapping. Therefore, there would be no valid fair value gap. Again, just to recap that, in the example of a 3 bearish candle series, the gap between the high of the first candle and the gap between the low of the second candle would be your valid fair value gap. And in the example of a 3 bullish series of candles, the high of the first candle and the low of the third candle, if they're not overlapping, that gap in between is what you call your fair value gap. Alright, so let's take a look at 1 or 2 live examples. In this example of a 3 series bearish candles, we can have a look at the low of the first candle and the high of the third candle. The low of the first candle and the high of the third candle is not overlapping. Therefore, we can mark this out as our valid fair value gap. Now, if you notice as I play this throughout, you will see that price often likes to fulfill these gaps and act as a magnet for price to continue in the expectational direction. Alright? Price fulfills that fair value gap and continues to target these weak lows. Alright, and now we get an aggressive move in the same direction, so we can look for the previous 3 series candles. We have candle number 1, candle number 2, and candle number 3. The low of the first candle and the high of the third candle acts as another fair value gap. So we can mark that out, continue price throughout. Alright, price fulfills that fair value gap and then violates that fair value gap. If we have to look for the nearest fair value gap, the previous 3 series candles, 1, 2, 3, 1, 2, 3, there is no fair value gap at the moment. Price has just fulfilled this fair value gap. If we look at the previous 3, 1, 2, 3, the high of the first candle and the low of the third candle is overlapping. Therefore, there is no fair value gap here. And if we backtrack, 1, 2, 3, no valid fair value gap, 1, 2, 3, no valid fair value gap, 1, 2, 3, right over here, at the high of the first candle and the low of the third candle acts as a valid fair value gap. You'll see over here, price already wicked this fair value gap, but didn't fulfill all of it. So therefore, in this scenario, if price just wicks the entry of a fair value gap, it is 100% valid to move that fair value gap to that next wick, as this gap still acts as a valid fair value gap. Okay, so let's highlight this as of our FVG. Let's play price throughout and see what happens. Okay, price wicked that fair value gap, reacted, and is now continuing in the same direction. All right, let's continue this through. Candle 1, 2, 3, right over here, the high of the first candle, the low of the third candle is a valid fair value gap. Let's continue. All right, violation of that fair value gap. All right, price fails that fair value gap. Let's continue this through. Until we see a clear fair value gap. All right, over here, in this 3 series bullish candles, candles 1, 2, and 3, we take the high of the first candle, the low of the third candle, and we can mark this out as our valid fair value gap, as these wicks are not overlapping. Price mitigates that fair value gap and continues in the expectational direction. Let's continue this. Okay, so over here is a good example of candle number 1, 2, and 3. The high of the first candle is overlapping with the low of the third candle. Therefore, there is no fair value gap. Okay, candle number 1, 2, and 3. We can take the low of the first candle, the high of the third candle. These wicks are not overlapping. Therefore, we can mark this out as our valid fair value gap. Okay, we have another valid fair value gap, candle number 1, 2, and 3. The low of the first candle and the high of the third candle. We can mark this out as a valid fair value gap. All right, mitigation and continuing in the expectational direction. Right over here, candle 1, 2, 3, no valid fair value gap, as the low of this candle is overlapping with the high of the third candle. So we can continue this throughout. All right, further mitigation into that fair value gap. Mitigation into the extreme fair value gap, reaction, and we formed a new fair value gap, candle 1, 2, and 3. We can mark out the low of that first candle, the high of the third candle. Those wicks are not overlapping, and we can mark this out as a valid fair value gap. All right, mitigation and violation, and we have now formed candle 1, 2, and 3. A new bullish fair value gap. So we can mark out the high of the first candle, the low of the third candle, and mark this out as a valid fair value gap, as those wicks are not overlapping. Okay, price didn't pull back into that fair value gap, and we continued in the expectational direction. Right over here, from the high of the first candle to the low of the third candle, candle 1, 2, and 3. And this is where live price is today. So what we can potentially expect on Euro USD is, after this break of structure, potentially a bit of a pullback later today in this fair value gap to continue long. And once you start understanding the power of fair value gaps, liquidity concepts and your structural context of the market, you can start to formulate a very powerful system for yourself. Okay, so let's go over one or two things that we would like to see price do as price is entering a fair value gap. My favorite scenario for a fair value gap is a liquidity sweep into that fair value gap. So over here right now, as price lies, what I would like to see is price pull back, have a bit of a reaction, creating liquidity to form above this fair value gap. So I'm going to mark this out as a sweep. This often adds as good confluence and fuel for this fair value gap to hold, to sweep this low further into this gap, to then look for an entry confirmation such as a displacement with a lower time frame fair value gap to go long, to continue targeting these weak highs. One thing that I want you to take note of, and that you will learn throughout any of the content that you watch of mine, every single point of interest, area of value, whether that's a supply or demand zone, or whether that's a fair value gap, there needs to be resting liquidity above or below that specific POI in order to make it more valuable, and the probability of that specific POI, which stands for point of interest, to hold and to continue in the direction that you expect. In this example that we marked out earlier, from the first candle's low to the third candle's high, we have a valid fair value gap as these candles are not overlapping. A good probability of this fair value gap holding is if price mitigates this fair value gap and candle closes below this fair value gap. Okay, just going to quickly draw this out. We want to see this candle body close after the wick mitigation into this fair value gap, react and close. This is what we call the consequent enroachment. This is what we call the consequent enroachment, which is a good probability that this fair value gap is going to hold. If price mitigates this fair value gap, forms a body closure above this fair value gap. Let me just quickly mark out the wicks of this candle. All right, so we've had price pull back, mitigate, and close candle body closure above this fair value gap. This is what we call an inversion gap, where price often likes to pull back, retest this old fair value gap, and continue in the expectational direction. So these are two things that I want you to make notes of. A good probability fair value gap is a body closure below a bearish example, such as so, which will then be good probability that price will continue in the expectational direction. Point number two is if price closes candle body closure in the opposite direction, so for example, above in this bearish example, this fair value gap will now act as an inversion gap, where price often likes to pull back, re-fulfill this gap, and continue in the expectational direction. Okay, so let's go over a lower time frame example. Right over here, we have a valid 4-hour fair value gap, as these candles on the low of the first candle is not overlapping with the high of the third candle. We can then hop over to a lower time frame. So from the 4-hour, I mechanically go over to the M15 time frame. We do have valid resting liquidity above this fair value gap, which we want to see get swept into that higher time frame fair value gap. Okay, as we play price throughout, we've had the sweep of that liquidity, mitigation of that fair value gap, reaction, and we've now printed a lower time frame fair value gap displacement inside of the higher time frame 4-hour fair value gap, which can often act as confirmation to continue your trade and where price is going to go from there. Okay, so if we take candle number 1, 2, and 3, we mark out the low of the first candle and the high of the third candle. This becomes our valid lower time frame fair value gap. Okay, so as I set a limit order on this gap, stop above the candle's high. Let's say we're targeting a mechanical 1 to 3 risk to reward. If you look at your higher time frame structure, understanding that these lows are weak, the expectational order flow is actually to target these weak lows. All right, so let's continue.
Okay. Slight mitigation of that fair value gap and fulfillment of that gap, and price now continuing in the expectational direction. And price is now targeted those 4-hour week lows. And if we have a look at the higher time frame, you will see that price mitigated this fair value gap, and the candle body then closed below this fair value gap and opened up this new candle over here, which again was good probability that price is going to continue in the expectational direction. All right, so let's have a look at an example of an inversion gap. Right over here, we have a series of 3 bearish candles, 1, 2, and 3. We can mark out the low of the first candle and the high of the third candle, which makes 100% valid fair value gap. Let's continue price and see how price reacts to this gap. Okay, so over here, we had mitigation of this fair value gap. Price then closed the candle body above this fair value gap. So what can we expect? It's a bit of a pullback and price to continue. All right, there's that pullback. The mitigation of the fair value gap turned inversion gap to continue in that direction. Price busy fulfilling that gap again and continuing in the expectational direction from there. So let's continue this through and have a look at some more examples of an inversion gap. Keep in mind, we still have this old fair value gap from earlier, which from this candle's low to this candle's high has not been mitigated until over here. However, the fair value gap has not been mitigated fully, so therefore in this example, we can continue this up through these highs over here. Now we've swept buy side liquidity into this fair value gap. Let's have a look at how price reacts. Okay, price closes candle body below, so good probability that this fair value gap will have some kind of bearish reaction. All right, we get that bearish reaction, then the failure of that fair value gap. So we can now drag this across. This old fair value gap now becomes an inversion gap. So what we can expect is a bit of a pullback to then continue in the expectational direction from then, which at the moment where price is currently lying. Also understanding why this fair value gap didn't hold is because most recently we had this break of structure to the upside, strong protected lows. This was a weak exposed high. So the expectational order flow is to target these weak highs. So instead of looking for bearish fair value gaps to go short, we want to look for bullish fair value gaps or inversion gaps to rather go long. We had a beautiful example of a bearish fair value gap fail and act as an inversion gap to continue targeting these expectational weak highs. Okay, so let's take a look at an example of a volume imbalance gap. In this example, you'll see between these 1, 2, and 3 candles, there is a clear skip in price from the first candle's low to the third candle's high that has not been fulfilled at all. There is no candle action and price action that has occurred in this area of price, which often price acts as a magnet to refulfill, rebalance, and recorrect price. In this example of such a large volume imbalance gap, it would also be valid to mark out the 50%. So what will most likely happen is price will pull back, fulfill areas of this volume imbalance gap to continue targeting potential lower down bullish fair value gaps over here as your target. So let's see what happens. All right, price pulling back, busy filling that volume imbalance gap, also mitigated the 50%. And take note of how after we've mitigated that 50%, we produced another confirmation of a candle 1, 2, and 3. The low of that candle, the low of the first candle and the high of the first candle is not overlapping. We've had that displacement with fair value gap, which is good confirmation that this overall volume imbalance gap is going to hold. So we can expect price to mitigate this and continue short from there. Let's see what happens. All right, mitigation of that displacement fair value gap inside of the larger volume imbalance gap to continue price. Okay, take a look at this example over here. Here is another example of a volume imbalance gap. At the low of the first candle's body and the high of the second candle's body, we have a complete skip in price. Yes, the wicks are overlapping, but the bodies are not overlapping. Same thing over here as well. The gaps between these two candles' body has been skipped in price, so price often acts as a magnet to this area to re-fulfill, rebalance price, to continue in the direction from there. So what can we expect here is a pullback into this volume imbalance to continue short. Let's have a look at what happens. Okay, so in this example, price ran without it, but what we can expect later on is still for price to re-fulfill and rebalance price in this area. So let's continue through price and see what happens. Okay, in this example, price just having a bit of a pullback, mitigating this overall fair value gap and also re-fulfilling this volume imbalance gap to continue short from there. All right, as price is starting to mitigate these higher time frame fair value gaps, we can start to look for displacement fair value gap entry confirmation. All right, mitigation of that bullish fair value gap. We've now printed a new fair value gap with a displacement candle 1, 2, and 3, especially after the sweep of this sell side liquidity. So what can we expect price to do is to pull back into this area of fair value gap to continue long from there. Okay, mitigation of that gap. Price continuing in the expectational direction from there to potentially fulfill these older areas of volume imbalance. Okay, and price has now fulfilled that volume imbalance. Price busy reacting off of this older fair value gap over here. So we can expect price to continue reacting off this larger fair value gap to continue higher. Okay, and price busy targeting those expectational weak highs. I hope you guys have a better understanding of fair value gaps, volume imbalance gaps, and inversion gaps. Without further ado, take care and I'll see you in the next video of this MMFunded ICT Bootcamp.